Good evening and welcome once again. Let me introduce myself. Hi, this is Rajesh Jain. I'm a financial planner and an investment coach. Basically, in terms of qualification, I'm a background. Basically, started my career as an advocate. I practiced for a couple of years in High Court. Then I completed my CS, Company Secretaryship. I worked in corporates such as Surana Group, CK Birla Group, as a secretarial and legal head, and also other capacities. Then I did my executive program in finance from IIM Kozhikode, and by good luck, I was topper of my batch. Then I moved completely into finance. I worked for about 3 years in Shakti Horman. It's a German MNC. I worked there as a CFO, and then I quit my employment. And for the last over 3 years, I'm into my entrepreneurial journey as a financial planner and investment coach. So, and I'm the financial expert of Ethica Work Life, that is Iii-Myswish Work Life, which is currently called as Iii-Myswish Work Life. And we are all together today because of the courtesy of Iii-Myswish. So, the current session is basically the third session of 4 session series. This is actually a 4 session series. This is the third session. There are, I think, many of you are the first timers here. So we will be having just a quick recap of the earlier sessions, but not in detail. But yes, at the same time, the sessions have been designed in such a manner that each and every session can be treated as an independent session, so that people who are joining for the first time, still they can take value from it. So don't worry, people who are joining for the first time, don't worry, you can still take value from this session. So basically, the 4 series session started with like first session where we discussed about money mindset and the relationship with money, because at the end of the day, it's all about what and how you think about money. So it's always said the major difference between a rich and a poor is not the amount of money he's earning or the kind of background he comes from. It all depends on the kind of mindset he has about money and the conversation he has about money. So in the first session, we explored what is our relationship with money, what kind of personality we have when it comes to money. That's what we explored. Then in session 2, we learned about how should we responsibly plan our own finances, like defining our financial goals. How should we go about defining financial goals? A relationship with income and expenditure, evaluating our income and expenditure. Then finally, we moved into like what is financial freedom, what does financial freedom means to you, and ultimately, how can you decide your retirement age, that by when you want to retire and how you should be financially free. So this is what we discussed in the previous 2 sessions. Then in the current session, we will be discussing about understanding the risk appetite. What are the various investment options? What are the various investment options that are available to you? We will try to get each and every investment option slightly in depth, not in detail. We cannot cover everything into one session, but we will try to see that as much as possible, we can try to understand and analyze each and every investment option. And finally, the same thing will be connected into the next session into a goal-based investing. That how can you start investing by linking each and every investment to your one specific financial goal. And the last session will be taking up a case study of how can a person identify his current investment gap analysis and plan for his future investments in a way that he can attain financial freedom. Yeah. Previous 2 sessions, I shared an Excel sheet with each and every one. And in the Excel sheet, I asked them to evaluate their income and expenditure and fill in their incomes and expenditures to identify where the money is coming from and where the money is going out, and which are the areas where they're focusing more and investing more and spending more. That was what the whole objective of this sheet was. Then I also asked each and every one of participants to prepare their own personal balance sheet. We always know that balance sheet is prepared by corporates, but not only corporates, each and every individual need to have his own balance sheet, which should be updated once every year. So to understand that what is his asset, what is his net worth, and what he owes to other people, like what are his liabilities, like what are the various loans that are there on him, what are the various outstandings that he is carrying forward. So then in the session two, we discussed on how to define financial goals, like trying to create that, okay, in future, what are going to be my financial liabilities or responsibilities? What are the various dreams and aspirations I have? Which again, because at the end of the day, whether you speak about any responsibility, you speak about any dream, or you speak about any aspiration, everything has got its price ticket on it. Am I right? Now, we have got a lot of people here. Can I know what kind of responsibilities that you're carrying? And when I say responsibilities, responsibilities means something which you are committed to, whether you have expressly said or not. Like my responsibilities, personal responsibilities are number one responsibility is giving a great education to my children. That is my child education. I've got two daughters, Naina and Achal, 12 years and 14 years. So my primary responsibility becomes giving my kids a very bright future by educating them enough, whatever they would like to. My second responsibility is giving a very uh, luxurious retirement feel to my mother. Unfortunately, I have lost my father, only have one mother and two siblings. So my mother is fully dependent on us financially. So that's my second responsibility. And final responsibility of, I'm speaking about the top three responsibilities. And my final responsibility is ensuring that by the time I retire, me and my spouse, we both have enough net worth and enough wealth that we can lead our retired life peacefully, comfortably, and independently. Now, these are my three responsibilities. So, can I know what are your three responsibilities? Top three responsibilities. Quickly type into the chat window. What are your top three major responsibilities? By the time you start typing your top three major responsibilities, keep typing into the chat window. Let me have a look at it. In addition to the responsibilities, what we also have are dreams and aspirations. We have dreams, we have aspirations to achieve something. To like my dream is to buy a caravan along with my wife, roam around entire India without any worry or without any restriction on like how many days I can move or how many days I can afford. That is my dream. Now, each and every dream comes with a price. No dream can be free. Is there any dream that would be free of cost? Is there any major dream of ours that can come free of cost? Is there anything? Okay, Kathiresan, to pay back 50 lakh loan is my first responsibility. Okay. So being now, Kathiresan, when you said pay back 50 lakh loan is your primary responsibility, let me put it one thing to you. What are you focused on? When you say paying back loan, are you focused on the loan or are you focused on enhancing your net worth and becoming financially free? What are you focused on? Isn't your focus every time on loan, 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 loan? And when you think of loan, does it give you any inspiration or any positive energy to work for it? It always makes you feel little that, yeah, I have got the burden of so much of loan on my head. So when it comes to goal, the goal should always be something positive and something that motivates you and inspires you. So for me, if I have to take, like I've got 50 lakhs loan. So for me, if I have to make it positive and appealing, what I would say is, okay, I need to earn, I create a net worth of at least 50 lakhs in the next 2 years so that I become financially clutch free. That I don't have any clutches as of now. I'm not saying financially free, but at least there are no clutches. There are no burdens that are holding me back. Okay. So that is one thing which you need to keep in mind while creating goals. And when you're creating goals, don't be miser at all. Be very generous as possible, and try to plan as many goals as you wish for, and then give every goal a proper ticket price, that how much that goal is going to cost you today, how many years are there for it, and what would be the expected future cost. So that indicates that in how many years you need to create that kind of wealth which you are looking for today. And once the goals are created, so till this section we actually covered in depth in the previous two sessions till this section. So once the goals are created, what is the next thing that is required? Obviously, if I have to achieve anything in my life, I need to take actions, isn't it? Money says to build enough assets so can live chill retirement, give comfortable retirement to my parents, and live comfortable present. Good, Manish. Yeah. So anything that is required to be achieved, the first thing that needs to be done is, what is that is required to be done? Taking the first step, isn't it? Taking the first step. Getting into action. Now, when you need to get into action, see, investment is like a journey. Like how each one of you stated are like, Manish has created a destination. For Manish, he has decided a destination for himself, saying that my destination is to financially reach to a position where I've got enough assets so that I can live a chilled retirement, give comfortable retirement to my parents, and live comfortable present. Okay, fine. It sounds really good. But is this really specific? Do we know what is the amount of assets? Like what is that one figure which will make Manish financially free? 5 crores, 10 crores, 15 crores, that one figure. And by what time? By when? Like for me, as per my calculations, if I have to be financially free in the next 10 years, then by end of the 10th year, I need to create a financial net worth of 12.5 crores. 12.5 crores is the amount which I need to create in the next 10 years if I need to be financially free. That is, I move out of my active earning life and do whatever I feel like in my life. Now, this is the journey and that is the destination which I have decided. Now, any journey depends on what is the kind of vehicle that you choose for, isn't it? What is the kind of vehicle you choose for? Like if I have to travel from here to Mumbai, and if I have to travel only in 2 hours, so what is the vehicle that I need to take? If I have to travel from here to Mumbai and need to reach Mumbai in next 2 to 3 hours, what is the kind of flight? Am I right? Yeah. If I have a time where I can reach in next 24 hours or 30 hours, I need not start immediately. I can start at whatever option I have available at the earliest, and I can reach in next 24 to 30 hours. Then what would be the best option? Yes, Vani, train. Train would be the best option. Now, if I cannot wait, I need to start immediately, but I cannot afford flight, or I don't have a flight available, but I need to start immediately. Then what is the best option available to me? It's by car, by road. Am I right? By car. Now tell me which one of it is good, whether going by flight is good, whether going by train is good, or going by car is good. In fact, it actually depends on the circumstance, isn't it? Isn't it? It all already depends on my circumstances, that how much money I'm willing to pay, how much time I have, and what are the various options that I have in my hand. Okay. But if I'm scared of flight, is that option available to you? Me? No. Because I'm not willing to take that risk. I feel flight is quite risky. I'm not willing to take that risk. Or I've got car phobia. At the moment I sit into the car, I start vomiting. Can I take the car? No, I can't. Or if I have to take a car, I need to mitigate it by taking a pill or something. Isn't it? This sounds so simple, no? That, yeah, roj ka hai, why the hell is talking about? Isn't it? You must be thinking, yeah, this is what we have been doing, but why the hell is talking about? In fact, a similar kind of approach is required for investment. You need to identify first, what is your destination? That is, what is it that you want to achieve? How much time that you have, then what is the risk taking ability that you have, and then finally choose an asset class or an investment option that fits in all these three together. That is where I want to go, that is how much I want to earn, how much time I have, what is my risk taking ability. Am I right? Am I making sense? Am I making sense? If I'm making sense, type sense. And if not, type nonsense. Let me see if anyone types nonsense. If anyone hesitate to say nonsense, you can type that as a direct message. Don't worry, I will not get affected. Okay. Yeah. Thanks. Fortunately, none of you type nonsense. So how to understand my risk-taking ability? How to understand my risk-taking ability? Like each one of us know, okay, that there are so many options available for investment. Everyone know which investments gives the highest return and everything. But do I have that kind of ability to take risk? Do I have the ability to take that kind of risk? Now, how would I determine whether I have what is my risk appetite? The best way to ascertain my risk appetite would be to evaluate what is the kind of return I'm happy with and what I'm willing to do to achieve that return. So say, for example, my intention is the boss, whether my rupee, if I'm investing 100 rupees, this 100 rupees, whether it becomes 101, 102, 103 or not, but this 100 should not get reduced to 99. That is, I want my capital security. I want my capital to be secured. I don't want to lose even a single rupee, no matter if I'm not earning a single rupee on its own. Okay. How many of you feel you belong to this category? If any one of you belong to this category, type I, where for you, your capital security is primary. One, you are typing messages directly to me. Select as to everyone so that everyone would see your responses. Okay, yeah. So then you can term yourself as conservative. So conservative people. So you're very conservative in nature. So that is one. Okay, there is nothing right or wrong about it. Okay, so you're very conservative. Now, second, hey boss, I don't want to take much risk. I'm not a very risk-taking guy, but at the same time, I want my 100 to grow a bit, at least to inflation. If my inflation is there, like we have about 4 to 5% inflation or 6% inflation. Inflation is there. At least the return should be equal to inflation. My money should, if it is not growing, it should not degrow, because if inflation is there and if my money is not reaching up to inflation, what actually happening? My money is degrowing. Then you are moderately conservative. But then if your expectation is that yeah, inflation is there, it is about 5%, and if my money is also growing by 5%, then there's hardly any growth. My money is only getting maintained. So I need some amount of growth on it. And for that, I'm prepared to take a little risk. Not much, but a little risk. Now, what is the kind of return expectation I have? Inflation is 5% plus 2 to 3%. That is 7 to 8%. So I want a 7 to 8% kind of return, for which I'm prepared to take a little risk. So that then you can categorize yourself as balanced. Then the next category, where many of the investors would like to belong to. Inflation is 5%. I require a return of at least 5 to 7% over and above it. That is 5 plus 5 to 7. That is something between 10 to 12%. So at least 10% return to आना ही मांगता है. So many of the investors, basically, a survey says that many of the investors, their return expectation lies something between 9 to 12%. So majority of the investors always love to belong to this category, which is called moderately aggressive. They don't want to be completely conservative. At the same time, they don't want to be highly aggressive. They are fine with it, with taking a slightly higher risk for a better return, but they don't want to take extremely high risk. So that is called moderately aggressive. And the final kind of category is, boss, any return less than 20% is waste. I need at least 20% return year on year. And if it is 30-40%, kya baat hai? So these kind of people are very aggressive and they are risk takers. Like they don't mind taking risk where they can lose their entire money overnight. They are prepared to take that kind of risk. So whether they would achieve their goals or not, but it is all about risk taking ability. So they are called aggressive. Now type into the chat window which of the below five you feel you belong to. Conservative, moderately conservative, balanced, moderately aggressive, or aggressive. Which category you belong to? Venkatesh says balanced, Ashwin says balanced, okay, Manish says balanced, Vani says balanced, Srishti says balanced. Wow, each one of you, most of them I'm seeing balanced. Gaurav says moderately conservative. So majority of you belong to balanced. Okay. Now there is another way of looking at risk. What is risk? Risk is not knowing what you are getting into. So say I'm investing into mutual funds. I'm investing into mutual funds. So when I'm investing into mutual funds, if I don't know anything about mutual fund and I just blindly investing by asking a friend or just by getting into an app and whichever the funds that app is suggesting, I'm just blindly investing into it. Isn't there a risk of ignorance that I don't know what I'm getting into? Isn't it? There's a risk involved of not knowing it. So a person can increase his risk appetite. How can a person can increase his risk appetite? How many of you are interested to increase your risk appetite? Type I am if you are interested to increase your risk appetite. Manish says I, Ashwin says I, Venkatesh says I. Okay. So whoever are interested to increase his or her risk appetite, the only way of increasing your risk appetite is getting financially literate. Understanding the various investment avenues, understanding the asset class which you want to invest, and knowing how can you evaluate and invest into it better. And why you need to increase your risk appetite is the longer you see, the better you are actually investing into. Like if I'm investing, if I'm very conservative or moderately conservative investing into an asset class which has a potential of giving only 6% return. If it is giving only 6% return, and I'm investing 10,000 every month, then how much this 10,000 every month that is being invested grows in 25 years? At 6%, it becomes 67.97 lakhs. But the same thing, if I'm investing into an asset class like mutual funds, which has a potential of giving between 10 to 12%, what would be my return? It would be 124 lakhs to 170 lakhs. That is almost double or triple. So this is where the kind of vehicle or the kind of asset class you choose matters. And see, just from 6 to 10%, that is 4% return. So for you, it may appear only a 4% return, but this 4% return has an ability to double your net worth. It has an ability to double your net worth. And this is where you need to focus on. You need to, so if you see, first thing is getting aware that what is your risk appetite. So as you all said, okay, most of you, your risk appetite is balanced. Now getting present to your risk appetite is one thing. Taking actions to increase your risk appetite. Because you don't want to stay. See, what is growth? Growth means moving ahead from where you are, isn't it? So if you want to stay the way you are, is there any growth in terms of your financial literacy or in terms of your financial prudence of investment? No. So you can increase your risk appetite by educating yourself into various asset classes. And if you increase your risk appetite and start investing into asset classes prudently, which gives you between 10 to 12% or 14% return, see the kind of net worth that you can generate by just investing 10,000 per month. So the table in the top is 10,000 per month. Table below is you are investing 10,000 per month and increasing it by 10% year on year. That is first year 10,000, second year 11,000, third year about 12,100. If you are increasing 10% year on year, see the kind of net worth that you can create. So if a person who is at 25 years, or say 30 years. He want to invest for his save for his retirement. He want to save for his retirement, and he want to create a corpus of 5 crores. If he invests 10,000 per month and increase it by 10% year on year, and invest into a good equity mutual fund which gives between 12 to 14% return, he can create a net worth of 4 to 5 crores by this 10,000 every month. And this is where we start, that the early you start, the longer you can go and the higher you can reach. So is this point very clear? And this is what we call the power of compounding. And compounding happens with two things. First thing, the potential of the asset class to generate returns. Second, what is the investment tenure? That is, if I speak about vehicle, what is the ability of vehicle to reach the top speed? And second, what is the kind of mileage that the vehicle gives? So let's look at what are the various investment options that we generally prefer. So there are far more other investment options, but we will be speaking about only the popular investment options. Yeah. If any one of you want to speak about Bitcoins, a cryptocurrency, we can talk about it later. I'm not going to deal with cryptos today at all. I'm very clear. Okay. So what are the major investment avenues which we basically look at investing? First is gold, the very popular thing. Which is the second preferred? For Indians, we basically prefer first gold, investing into gold. What is the second preferred option? Can I get some responses? Real estate, land, yes.
Yeah, government schemes.
Yeah, government schemes which are like debt. So the second option is always debt or real estate. The first option is gold, no doubt. Second option has always been either debt, like government schemes, or your postal investment schemes, or maybe your chit funds. Chit funds also fall into debt. Debt or real estate, buying a plot, buying a house, that is the kind of investments that we normally look for. But do you know which asset class of the four has given consistently higher returns in any 10 years bracket? I'm speaking about any 10 years, like 1970 to 1980, 1980 to 1990, 1990 to 2000, 2000 to 2010, 2010 to 2020. If you break any 10 years block, which asset class has given consistently higher return, and in most of the times double digit return? So the asset class which has given the highest return in the last, in any decade, any 10 years bracket, is equities. And which is the least preferred. Only 4% of the Indians invest into equities, and majority of them prefer investing into either gold, debt, or real estate. Now, when it comes to gold, first thing, when it comes to gold, what is the function of the gold and how gold works in investing? Gold is basically a hedge against inflation. So in a longer term, if you see, compare gold returns, in a year, gold might have given 15 to 20% return. Another year, it would have given minus 10 or 15% return. That is how gold goes ups and downs. Gold has never given a consistent return, but it has given up and down. But if you take any longer 10 years period, gold has always given a return equal to or in and around inflation. So gold is always considered to be hedge against inflation. And gold always gives you a higher return whenever there is uncertainty to economy. Like if you see in 2020, gold has given exponential return. It has given a return of over 20 to 30%. And why it has given? Because of COVID. Because of COVID, there was uncertainty into economy. No one knew what happens. Like even in times of war, basically whenever war happens or anything, there is a certain economic uncertainties. Gold always performs better. It gives you a higher return than any other asset class, because there is uncertainty whether this asset class will be there or not, and whether the demand for it will be there or not. But gold will invest more than 10% of your portfolio into gold. At best, you are very much gold lover. You can go up to 15%, but the recommended percentage of gold investment would be 10% of your total portfolio. The next is debt. I will come to equity later. I will come to equity at the last. Next is debt. Means anything you give popular of form of debt investments. One is chit. Chit is very much popular into South India. In North India, I think in Mumbai, what they call it BC. How many of you have heard about it? Am I right? Guys from Mumbai. BC, no, that is what I called. Like in South India, we call it chit, chitipata, chit, and in Mumbai it is called as BC. So this is one of a very popular household form. Now chit is best for short term. If you want to, like, if you have like a money need in next 1 year, 2 year, 3 years, and you want to accumulate some large sum by investing little amount, and you don't know when you will be requiring that money, chit is the best form for that. But yes, what is the risk involved in chit is most of the chits are unorganized. It is always invested through a group of friends or through an uncle or someone who is known who prepares this group, and it is invested through them. So that is a risk where it is an unorganized, there is nothing in writing. So if there is a default, there can be a huge setback. But when it comes to a short term, like for next 2 to 3 years, so for example, I want to take a home, and for my down payment, I want to accumulate money, and I want to buy this home in next 2 to 3 years, but I don't know when I would need this money. So if I'm investing into chit, what happens is in next 1.5 year, I come across a good home. I can always raise the chit, take out money from it, and put my money into my home. So chit is best option for a short-term goals. But for long-term investments, chit is not a good option. Second option, which we popularly exercise in terms of debt, is fixed deposit. Now, fixed deposit, though it's popular, most of the times, fixed deposit only gives you a return which is equivalent to inflation. So currently, what is the fixed deposit interest rate that is coming? Somewhere around 5.5%. Am I right? Banks are not giving more than that, 5 to 5.5%. What is the inflation? Almost same. And then fixed deposits are again taxable. The interest that you get from fixed deposits is taxable. Third popular option of debt is debt mutual funds. In mutual funds, there are also debt mutual funds. How many of you are hearing that there are debt mutual funds for the first time? Is there anyone who was not aware of that there are debt mutual funds as well? Mutual fund doesn't mean only investing into stock market, but there are debt mutual funds. Yeah. So debt mutual funds are there where the risk that you take in investing is lesser and the return that you get is somewhere around 5 to 9% depending on the kind of debt fund that you're choosing. And where these debt funds invest in their money into basically the low risk taking debt funds, the debt funds which take very low risk like liquid funds and all, they invest into government treasury bonds, which are completely risk free, almost risk free. They invest into government treasury bond and the yield, that is a return that they achieve, is very low because low the risk, low the return. Then there are certain moderate debt funds like short-term debt funds and all, where they invest their money into AAA rated. See, every company in India, when they are raising money from debt market, they are supposed to get themselves rated, which is called credit rating. Now, AAA is the highest form of credit rating. That is, the credit rating agency is saying that if you are lending your money to it, your money is highly secure, highly safe. That is the chance of that company getting default is lowest. So this moderate debt funds, they invest into AAA rated debt funds. Then there are certain credit risk debt funds. Credit risk debt funds give you a higher return. At the same time, they invest into companies which are having a high probability of default. That is, they are taking a credit risk. That is risk of default. And last form is corporate bonds. Now, corporate bonds is where you directly lend your money to a corporate. A corporate is coming out with a debt debenture issue, and you are buying or you are lending that money directly to a corporate. They are called corporate bonds. Now, investing into corporate bonds is slightly riskier when compared to debt mutual fund, because in debt mutual fund, what you are doing, the mutual fund manager will go and buy this corporate bonds from 15, 20, 30 corporates. If one corporate defaults, still overall, the portfolio would be still in positive. The impact of it would be not much. But if you are directly buying a corporate bond from a XYZ corporate, and if the corporate defaults, your entire portfolio will become zero. So unless and until you are aware of debt markets, one should always invest into debt mutual funds for a long term this thing. And if you are investing for a short term requirement, you should prefer chit fund. Chit fund would be preferred option for 1 to 2 years, and more than 2 to 3 years or 5 years option, your debt mutual fund would be a better thing. Then comes real estate. Now, real estate is a good investment option, no doubt. After equities, the next best option for high level of growth is real estate, no doubt about it. But what are the challenges of real estate? Can anyone say what are the challenges of real estate? First, real estate is highly illiquid. If you are buying a plot of land today and if you want to sell it tomorrow, is it easy? Can you just like today you got a need and you want to sell it off immediately? Can you sell that plot immediately? Is it liquid? So this feature of any asset is called liquidity. That is how easily an investment can be converted into money. That is called liquidity. Like gold. If you want to get money, you can just walk to a gold shop, sell that gold and come back with a cash. Shares you have. You can just go to the stock market, sell the shares and come back with, walk out with the cash. But in real estate, can you do that? No, you cannot. Second, holding period. You need to hold real estate for a very long time. Can you guess what is the best investment tenure for gold, for real estate? If you want to be very sure that you would not be losing money into it and get a decent return, good return, what is the investment tenure to invest into real estate? Yes, Ashwin, you are bang on. 12 to 15 years. It's more than 10 years, Brahmaji, somewhere around closer to 15 years. 12 to 15 years is the time horizon and minimum 10 years. So if you know that the money which you are investing will not be required for the next 10 years, only then you should be investing into real estate. And the best option for investing into real estate would be go for a commercial property. Going for a commercial property which you can rent it out so that you get some regular income in form of rental yield. At the same time, there is a capital appreciation as well. And then we will come to the last option, which is equity. Now, what is equity? How many of you don't know what stock market is? If you don't know, type I don't know. How many of you don't know what stock market is? And how many of you know what stock market is? If you know, type no. If you don't know, type don't know that what stock market is. Since many of you don't know what stock market is, I will first try to say, see guys, the whole intention of the sessions are not to give too much of gap, but the whole intention is whatever we speak here, discuss here, should drive the point home. That is, each one of you should be able to understand that particular aspect of finance. That is the whole intention of this session. And that's the reason I'm going slowly. At the same time, I'm trying to explain each and everything is as simple as possible. So if you are not able to understand, if you don't know any specific aspect, feel free to ask me doubt and I will not mind repeating it again. Am I clear? Yeah. So what stock market is? So basically, if I have to do a business, if I have to start a business, what I can do, I can first start a business on my own, alone. Am I right? I can do it on my own. So that form of business is called sole proprietorship. That is, I'm the only proprietor. Now, where the money will come into, either I will put in my money or I will borrow money from others and put that money into my business. Am I right? At the end of the day, I am putting that money into the business. Then after a certain time, one of my friends came, like Manish came to me and says, Rajesh bhai, why don't I join your business? I said, fine, even I need money. So please bring in your money. Let's partner together and take this forward. So both of us started this business together. So what that form would be called? It would be called partnership. So from sole proprietorship, it became partnership. Now, after a while, we thought, why don't we invite many people to join our business? Why don't we call many people to join our business? Now, there was certain uncertainty, right? If so many people come and tomorrow if things collapse, each one of us would be liable to reap any of the business, isn't it? Which is called unlimited liability. Now, if I have to restrict my liability, say I'm investing only 10 lakhs, either I will lose this 10 lakhs, I will get some money, but beyond this 10 lakhs, I don't want to lose any further. Like none of my personal assets should get attached by the bank. Now, what that aspect is called limited liability. That is, my liability is limited to the amount that I have invested into the business. Now, limited liability, there are three forms: limited liability partnership, private limited, and public limited company. So, when I'm starting a company where the liability is limited and registering with register of companies, it becomes either a private limited company or a public limited company. Now I've got to know this private limited or public limited company have got restrictions. Like private limited company, maximum 200 people. Public limited company can go to any extent. Now, if I have to need to go to any extent, if I need so much of money, if I go and stand on the roads, if I ask people money, will anyone invest? No. So what I need to do, I need to have a platform where I can go, register my company into, and sell my company shares. Share means, as the word share means share of my business. That is, if my business is, say, the capital invested into my business is 10 lakhs. 10 lakhs. I need to divide each and my 10 lakhs into various pieces. Now, each piece is called a share. So, if I am issuing a 10 rupees share, but total 10 lakhs, that means I have made 1 lakh shares. That is 1 lakh parts of my business, and I'm selling to others. Like, okay, you want to invest how many? 5 pieces, take 5 shares. You have a capacity to invest for 50 pieces, take 50 shares. This is how I give my shares to people who want to invest into my company. And this is where I come out with an IPO. Now, recently you would have heard Zomato is coming out with an IPO. Zomato is coming out with an IPO where you and me can go and invest into Zomato, invest our money into Zomato's business and get profit from business. So basically, investing into stock market is like investing your money into other people's business. Since you cannot do your own business, you cannot start your business, you are an employee, you can go and put your money into other people's business and get profited from it. And this is exactly what investing into stock market means. Is this clear? Am I clear? Now, when you have to invest into stock markets, that is investing into equity, there are 4 popular options. What are these 4 popular options? 1, you can directly open a demat account, select which company you want to invest into, and invest into that company by directly buying the equity from the stock market. Now, if I'm a layman, don't know anything about stock markets, I don't know how to evaluate a company, how to analyze a company, how to review a company and select good companies. If I don't know anything about companies, I don't know how to evaluate a company's balance sheet. I don't know what is its industry or how to evaluate the industry and all. What I can do? Like, I bought a car, but I don't know how to drive. What I will do? I will hire a driver, isn't it? I bought a car, but I don't know how to drive. What I will do? Will I still take a risk and drive on my own? Or I will hire a driver and let the driver drive the car for me. What will you do? Hire a driver or drive on your own? You will hire a driver, isn't it? So people who don't know anything about stock market, but because they were getting bored in the pandemic and have opened a demat account and started investing in the stock market based on some friends' tips as here and there, they are doing exactly like they don't know how to drive the car, but they have taken a risk by starting driving their own car. Okay, of course, it's your money. You can risk your money anywhere the way you want. But if you don't know about anything about investing into stock market directly, the best way would be go with a fund manager. And the fund managers are available in 3 different places. One thing is mutual fund. So mutual funds, there are fund managers who will invest your money into stock market. Second is ULIPs. ULIP is unit linked insurance policies. That is insurance companies selling investment plans which would be invested into stock market. This policy is called ULIP. So basically, most of the money which you pay to an insurance company goes into debt market. unless and until you invest into ULIP policy. But ULIP, the money goes into stock market. So these are basically mutual funds run by insurance companies. So mutual funds, ULIPs. And the third option is portfolio management services, where you get personalized services by portfolio managers who would be managing your portfolio. But here, the minimum ticket size is 50 lakhs. Minimum 50 lakhs. So minimum 50 lakhs is a ticket size for a portfolio management services. So I wish each one of you become eligible to hire a portfolio manager and get investment into portfolio management services. So my best suggestion would be, each one of you who don't know much about stock market, please expand your risk appetite. Start investing into equity by investing into mutual funds. And that is where I would be covering a bit about mutual funds now. Now, mutual funds, there are three kinds of mutual funds. One, equity, second, debt, third is hybrid. So the mutual funds where the main objective to invest into stock market is called equity mutual fund, where they're investing into debt instruments like government securities, corporate bonds, corporate debentures, commercial papers. Then it is called debt fund. And there is a hybrid fund, as the word suggests, hybrid means mixed, where like partly it invests into equity and partly into debt. Then it is called hybrid. What about stock market brokers? Many stock market brokers are only service providers. They only provide you an access to a demat account. That's it. They create and give you a platform. That's it. They don't manage. They're not supposed to manage your funds. Yes, stock market brokers, they do provide you with tips so that you can do a lot of trades and they can increase their brokerage, but they are not supposed to handle your funds in a direct or indirect manner. When we further drop down into the kind of mutual funds, equity, the mutual funds are divided into large cap, mid cap, small cap, multi cap are now a new category for multi cap is flexi cap. And then there are sectoral funds. Now, what these large cap, mid cap, small caps are like, when you are getting into stock market, there are so many companies, like from Reliance to there's a very small company. So there is something called market capitalization. Market capitalization means what is the complete value of my company, and if someone wants to buy my company as a whole from stock market, what is that amount that need to shell out? That is total number of shares into my market price. That is called market capitalization. Now, based on the market capitalization, all these companies which are listed into the stock market are categorized, and top 100 companies, that is 1 to 100, are categorized as a large cap companies. So they are the large cap companies with big in size. So if they're big in size, that means the possibility of that company going bankrupt or going down would be low. So relatively a safer avenue in terms of mutual funds. Then second is 101 to 200. Sorry, 101 to 250. So 101 to 250, that is the next 150 companies are called mid cap, and 250 to 500 are called small cap, and below 500 are called micro cap. So these are the companies in terms of their market capitalization, in terms of ranking. So when I say large cap fund, that means the fund manager is supposed to invest only into top 100 companies. That is almost 80% of it should go into top 100 companies only. Mid cap means 101 to 250. Small cap means 250 to 500. Now, when I'm investing into large cap, mid cap, or small cap, what I'm doing, I'm restricting the hands of fund manager that which kind of companies he should invest into. So there is a new category called flexi cap or multi cap. Here, flexi cap means the fund manager can decide whether he want to invest into large cap, into mid cap, or small cap. So he can invest into any kind of company. He has got a free hand. And then there is a sectoral fund. Sectoral fund means the fund manager will invest into companies which belong to a specific sector, like IT. If I'm investing into IT fund, they will invest into IT or IT related. Or if I'm investing into financial services fund, he will invest only into financial services company like bank, NBFCs, insurance companies, only into this kind of companies. So these are the various equity funds. Now, the next question you may ask is, Rajesh, which kind of equity fund is best? Now, if you don't want to take very high risk, then large cap or mid cap are good. Don't go to small cap because small cap is highly risky. Large cap is lower risky. If you don't want to get into this cumbersome of large, mid, and small, best is flexi cap. Let the fund manager decide what would be the best for you depending on the market scenario. So let expert take the call. So I personally always recommend to invest a major portion of your fund into a flexi cap fund rather than into large and mid cap. I try to avoid sectoral funds. I personally try to avoid sectoral funds when I'm suggesting any funds to my clients. Then there are debt funds. Debt funds like liquid funds, ultra short term, short and mid term, long term. As the name itself suggests, it depends on the what is your investment tenure, for how long you want to invest. Based on that kind of fund have been categorized. So based on your investment, like how long you want to invest, you should, like if you want to invest only for 10 days, 15 days or 30 days, you should invest into liquid funds. But if you are investing for about 6 months, invest into ultra short term. But if I'm investing for 3 years, then I should go for short and mid term. And what are the ways to invest into mutual funds? There are 2 ways. SIP, lump sum. What SIP means is systematic investment plan, where no matter what is the level of stock market, no matter what is happening into the stock market, every month systematically I'm investing some X amount. Say I've started an SIP for 10,000 every month. I've fixed a date of 5th. So every month, 5th, 10,000 would get deducted from my account and would get invested into the mutual funds which I have selected. And it will happen every month without any intervention of mine because SIP works on ECS mandate. Then there is another category of lump sum. As the word itself suggests, I'm investing at a one go. But if I get a bonus, so suddenly I got a bonus of 2 lakhs, 3 lakhs. What I can do, I can invest 2 lakhs of my bonus as a lump sum into a equity mutual fund or a debt mutual fund. So which one is best? In fact, a combination of both you should go. You should start SIP for a decent amount which you can afford to every month on month, and then whenever you get some bonus or any windfall gain, you should do a lump sum investment. Or whenever you see there is a fall into the stock market, whenever there is a fall into the stock market and you have got some accumulated money, maybe in your fixed deposit or any other place, you can withdraw from there and invest into a lump sum kind of thing. Now, in terms of returns, so you guys can actually take a screenshot of this, that what is the tenure? What is the tenure of investment? So based on the tenure, which kind of fund or which kind of investment avenue is suggested, and what would be the expected return? So what kind of return you can expect on that particular investment? So like if you want to go for 30 days, you have an option of investing into savings or you can invest into liquid funds. Earlier, liquid funds used to give a slightly better return than savings account, but now they are just giving somewhere around savings or less than savings. But basically, liquid funds are used by corporates majorly. Because corporates, they invest into current account. Current account give a 0% interest. Current account doesn't need any interest. So since current account doesn't need any interest, they prefer investing into liquid funds so that they can get some amount of returns. So based on the investment tenure, the kind of funds you can select, and the funds that you should go for your long-term investment, for your long-term goal, because we are speaking about financial freedom. For your long-term goals, you should select a multi-cap, as I said, flexi-cap funds, or if you don't want to take much risk, then large-cap funds. And if your investment tenure is more than around 10 years, mid and small-cap funds. This is again for short-term goal and long-term goal, and depending on your risk taking, like risk takers and risk avoiders, where you should be investing your money into. So like if you are a risk taker and if you want to invest your money for a short-term goal, like anything less than 3 years. Here, when I say short-term and long-term, I'm speaking about 3 years and more than 3 years. So if it is less than 3 years, you should invest into a debt mutual fund or a corporate bond or a chit fund. But if you are going for a long-term goal, that is somewhere around 4 to 5 years, you should go for a direct equity or equity mutual fund, real estate, as I told you, 12 to 15 years, index funds, ULIPs, or direct stocks. Same way again, if you are a risk avoider, someone who don't want to take much risk, and for your long-term goal, what you can do is you can either go for a balanced mutual fund or fixed deposit, but fixed deposits don't grow your money. Balanced funds will grow your money somewhere around 8 to 9%. So they will give you a better return than your fixed deposits. Endowment insurance, like your guaranteed money back policies. The LIC policies are your HDFC Sanchay, are like ICICI Savings Suraksha, Gift. There are a lot of endowment policies that are available in the market, which are more popular and which generally people buy. So these endowment policies, which are called money back guaranteed policies, they basically give you a return of somewhere around 5 to 5.5% or at best 6% return, which is again very close to the return that you get to fixed deposits. Only difference is the return on fixed deposits is taxable. Return that you get from a money back guaranteed insurance plan policy is tax free. Land or apartment or any other depends. Brahmaji, I'm not able to get your question, please. Yeah. So finally, what I want to say you guys is, boss, the earlier you plan and the earlier you start your investment journey for your retirement, are you becoming financially free, the easier the task would be. So as we saw that someone who's at 25 is investing 10,000 per month and increasing by 10% every year. In next 25 years, if you're investing into equity mutual funds, the high probability is that he would be garnering 4 to 5 crores portfolio by the time he retires. By the time he is 50, I'm taking 50 as his retirement age. But the same guy, if he's taking it to 45, he has hardly got any time. So the earlier you plan for your retirement, the better it would be. And thumb rule, take a thumb rule for your retirement is that at the age of 25, from 25 itself, what you should do is 5 to 10%, minimum 5%, recommended would be 10% of your monthly income should go for your retirement purpose. How much I said? How much of your monthly income should go for your retirement corpus? Yes, 10%. And what is the right age to start your retirement planning? Yes, Brahmaji. Now, whatever is your age, it's a right age to start. So if you are 22, if you are 23, if you are 40, if you are 45, whatever may be your age, start planning for your retirement, because you may work or earn very well today, but there is a limitation. A person can at best work up to 55 or 60. But post 60, once he retires, there's a long life awaiting. Do you know what is the life expectancy currently in India? Life expectancy, that is average age. It is around 68. It is around 68. And by the time we go to 2025 or by the time 2030, this is expected to be somewhere around 75 to 80. And the same thing in 1950s, that is when we got independent in 1950s, the life expectancy was somewhere around 40 years. So at that time, people never had to worry about retirement because they never retired. But today, people do retire, and after retirement, they have a life of at least 20 to 25 years. So you need to create enough net worth which will let you live for next 15 to 20 years of your retirement without any hassle, without any tension. It should be like living life king size post retirement. So how many of you want to really aspire for this? That living life king size after you retire. Then what you should do is, first, as I told you, get present to your risk appetite and start working on increasing your risk appetite by investing your time in learning more about personal finance. And acknowledge each one of you who have become part of this session and who have spent time today. Really acknowledge you for investing your time for enhancing your knowledge in terms of personal finance. Second, write down your personal financial goals. Write down your financial goals. Get present to what you want to achieve in your life. Create an action plan for achieving that. And as I told, for long-term goals, opt for equity as your preferred investment option. And last but not the least, invest your time in learning more about how to invest in equities, that is stock market and mutual funds. So remember, knowledge along with consistent actions will empower you to take higher risks, and not just in investments, but also in your life. I would also request you to join our WhatsApp group, which is called Happy Money Club, and also request you to kindly connect to our Facebook page, Iii-Myswish, on Facebook as well as on YouTube. Both places we are present as Iii-Myswish. So you can connect at Iii-Myswish and give your feedback. I've got another 10 to 15 minutes to take any questions. If I increase my SIP contribution in equity mutual fund, when market is high, will it affect my return in any negative way? Ashwin, investment into mutual funds to SIP is always looked with a long-term perspective, and the whole intention of SIP is it gives you an benefit of averaging your investment cost. So say you are investing today into a market when it is very high, when it is touching somewhere around 16,000, and when you are investing into it, and after a year it falls to around 11,000, for that particular moment, yes, your investment will give you a negative return. But then when you're continuing your SIP, you again get a chance where you're investing at 10,000, 11,000, 12,000. And after a year or so, when your investment, when the stock market goes up, your overall investment will give you a better return. So that is the whole advantage of SIP, that no matter what is the phase of the market in the short term, in the long term, you will always get a decent return. Yeah, Brahmaji. When we talk about real estate, is it about land, apartment, commercial property, or anything? See, real estate means anything. Land, apartment, commercial property, any kind of real estate. My recommendation would be go for commercial property. And why commercial property is? In commercial property, you get a better rental yield, and also the possibility of commercial appreciation would be slightly better. See, on an average, a residential property gives you a rental yield of about 1.5 to 2%. That is 2% return rental yield, and a capital appreciation of about 6% average. I'm speaking about long term. I'm not speaking about immediate. Right? Today a project is announced, you're investing into a project, and after 2 years it becomes double. I'm not speaking about that kind of. That is a risk that you're taking and a gamble. Okay, I'm not speaking about that. I'm speaking about you have bought a property today and you're selling it after 20-25 years. So on 20-25 years gamut, residential property give you an overall yield of about 7 to 8%. Commercial properties are known to give you an overall yield of about 9 to 10%, and at times about 12%, depending on the kind of location and how the location has grown. Yeah. And plots, again, they have got their own inherent risk involved, because you're not getting any money return till you are holding the plot. Second, someone can go and do kabza. And plotting is normally done at remote locations which are not developed today, in anticipation that that area would get developed in future. Like in Hyderabad, Yadadri, the plotting has started almost like 10 to 12 years back, in anticipation that the Yadgiri Gutta, the temple, would become very popular and there would be huge development there. Even till today, not much development has come, but it is again anticipated that next 5 years it will become. So plotting is always done with a very long-term anticipation and looking at the kind of growth that area may happen. So it's a higher risk that you're taking. Yeah. Any other query?
So commercial properties, like what all you consider?
Commercial property are two. One is corporate offices. Second, there are small malls or this thing where you have a shops. In Hyderabad local lingo, we call it madgi.
Okay.
Small shutters, which are easily like small shutters. If you're like there is some commercial complex which is being constructed beside your house or in your own locality, and if you go and buy one shutter of about like 200 square feet or 300 square feet, it would not cost you more than 30-40 lakhs or 20 lakhs, 25 lakhs. Okay. So at a low cost, you can get into real estate, you can buy it, you can rent it out. The rental yield will be better than investing into an apartment or a flat. And since the property would be regularly occupied, you don't have an issue of kabza or any other thing. So guys, any feedback about the session? I hope you all enjoyed the session today. I hope the session was useful.
Yeah, Rajesh, I enjoyed the session. This is really very good. Thank you. Thank you so much.
Thank you, Rajesh. And thank you everyone for participating in the session. Happy weekend all.